Betsy, let me start with you, and I want to go straight to the question of the day. Is this a number that you think the Fed needs to react more aggressively? How would you characterize the labor market at the moment? Is it strong enough to justify a 50 basis point hike from the Federal Reserve?
You know, I actually don't think there is that much news in this report. And I know that's a very funny thing to say, given what a large surprise it was. But what it shows is that the economy is strong and has been strong. And Omicron didn't get in the way of jobs in terms of people either losing jobs or disappearing for an entire pay period. That doesn't mean that they were all producing at their top capacity for the month of January. What it means is employers were in the process of hiring people. They didn't stop that because people got sick for a little bit. They didn't let people go because people got sick. And even if they had a few slow days at their business, they didn't shut their doors. So we see that the labor market's healing. And in fact, if you look overall at this report, what you saw was we've had a more steady healing of the labor market over the last 12 months than we had thought. You know, we thought we had this great June, July, and then it was weaker at the end of the year. And what the BLS said is, sorry, actually, it looks like it was a little bit more steady throughout the year, sort of healing consistently.
All right, Mike McKee, I heard you laughing pretty hard when the number dropped at 8:30 a.m. Eastern time. I think it all took us a minute to digest what we were seeing. Do you think it wasn't ultimately that much of a surprise today?
Yeah, I agree with Betsy.
Okay.
It isn't going to be a surprise for the Fed, and it isn't going to change the way the Fed is thinking about it, because the way Wall Street has reacted, the number to people trading has been the change from December to January, but the change isn't comparable because, as Betsy was just saying, they did a lot of revisions to 2021 data, and what it's telling us is the job market was a little bit stronger in 2021 than we thought, but not all that much. But the numbers get revised up a little bit. And that's the problem here is the Fed knows now that it had a stronger economy than it even thought, but it doesn't necessarily mean that it has picked up or that we're going to see a big inflation surge out of it. The numbers in terms of average hourly earnings, when you look at the breakdown, a lot of that was in the construction field, manufacturing, and some of the higher paid jobs. And the people in the leisure and hospitality sector only gained 1 cent on the month, even though 151,000 people were added into that jobs category. So they're going to have to do a lot of deconstructing of the revisions to this and figure out exactly how it does affect things going forward. It's kind of hard to tell.
Okay, Mike, I take on board what you're saying about the complexity of these numbers, and they are complex. The bond market is moving higher in terms of the yield. The US 10-year now 1.9. We've moved beyond that. As you can see, a significant, well, a two-step higher. We get the CPI report next Thursday. If you put this labor market report next to a, let's call it a 7% plus print come next Thursday, where do you think that will leave the Fed? With the market moving higher, do you think this is something that's going to be increasingly hard for the Fed to resist? I saw the ECB have to react yesterday to market expectations. The data coming in significantly stronger than anticipated. Are we going to have to see another revision from the Fed in terms of its approach?
Well, not based on what we know now. I mean, the Fed has basically set its course based on that 7% CPI and the 5.3 or whatever it is, the PCE number. So they're not going to be changing unless we get a significantly higher inflation print over the next 2 months. And we will get 2 months worth of inflation data before the Fed has to make a decision. And let's see what happens with the jobs numbers next month, because they tend to revert to a mean. The mean's a little bit higher. Things are getting stronger, but it may not be as strong as it looks to the bond market right now.
Betsy, we were hearing from the Labor Secretary just a few minutes ago. He talked about wanting to get wages up and yet inflation down. I'm wondering how you look at this wage growth data in the prospect of higher inflation more broadly.
Yeah, so the risk to higher inflation in 2022 or continued high inflation in 2022 is not being able to hire people in the service sector as demand for services returns. So people with Omicron fading, they're going to want to get out to restaurants. They're going to want to get out to entertainment. Hiring in the service sector is what has lagged in this economy, right? We've gotten everybody back in the goods sector. Demand for goods is skyrocketed. It's demand for services that's lagged, and it's employment and services that's lagged. What we saw in this jobs report is almost all those jobs were added in the service sector. We didn't see a lot of upward wage pressure necessary to get those folks back. So for me, that looks like, look, the good news is people are going to come back to those jobs. Yes, we want to see higher wages, but we want to see higher wages coming out of higher productivity. We want to see us being able to get people back to services without just having to push the prices up. And I think that this report indicated, at least for now, we're pulling people back into the service sector without enormous upward pressure in prices.
Betsey, will that pressure come? It was interesting. We saw the participation rate for 55 and up in terms of the age cohort. The pickup we saw in this data was the largest rise since 2003. Are we starting to pull people back in that had thought about taking time out of the labour market, reconsidering their options, maybe retiring? Are we starting to see some of those people coming back into the labour market? And do you think that is a trend that is going to persist?
Well, I think we're going to need to spend some time digesting what's going on in the labor market for people over the age of 55. Look, there's some bad news that the census released, which was there are fewer older people out there than we thought. More of them had died. And because they're dead, they're no longer in the denominator. And that means that we've seen a higher labor force participation rate and higher employment rate of living people over the age of 55 than we thought we were seeing over the last year. So I think that does raise some questions about how much higher we can get that labor force participation rate of people over 55. I will say that was actually, I think, one of the saddest or worst parts of the report for me, because I think there is less slack in that older age group than I had previously thought before I saw these numbers today.
So obviously the higher participation rate probably going to catch the eye of the Federal Reserve, Mike, as will the wage number, as will all of it. Is there anything within this data, if it doesn't necessarily mean that the Fed is going to tilt in a more hawkish direction, that would indicate that they don't have to move as aggressively as the market is priced for?
Well, that depends on what the market is priced for when we get closer to the meeting. The Fed's going to ignore kind of what's happening with Fed funds futures or overnight index swaps until they get a lot more data. And we get another payrolls report, the February payrolls report. We get 2 CPI reports. We get another PCE inflation number report. Plus, we'll get all kinds of tertiary data that will give them a better idea of where the economy actually is. This report full of statistical revisions, both the benchmark changes and the seasonal adjustments that they make. They said they have improved the seasonals. So the Fed is going to have to look through this and wait. I mean, you talked about the participation rate went up by 0.3. Yes, but that was because of the benchmark revisions, not because it went up 0.3 in 1 month. It was 62 last month. And so at this point, the Fed kind of has to wait.
Betsey, one final quick question from me. I'm trying to bring together the ECB, the Bank of England, the Fed, and what the message is from all of them. And maybe there isn't a consistent message. But what I've been hearing over the last few days, the implicit message seems to be that the potential of these economies isn't as great as we first thought coming out of this crisis. And as a result of which we can't drive them as fast, we can't drive the car as fast without it shaking. Is that what central banks are telling us at the moment? Is that the underlying message here?
Oh, I mean, I guess I'm more of an optimist than you. So I think the underlying message is hooray for the central banks. Boy, did they get us back quick coming out of an unprecedented, or as Marty Walsh said, in the last 100 years, unprecedented pandemic. So I think they've done an incredible job. It is obviously the case that we lost some of our potential. The COVID cost was real. We're still actually paying it. We've had to dedicate resources towards fighting a contagious disease that could be used to produce goods and services we want that are not related to a contagious disease if we didn't have one. So we've clearly lost potential. But I don't think that the message here is that they've been driving the car too fast. In fact, I think it's that they really did the right thing for getting an economy to heal very quickly.